I was sitting in the third row, left side, in Wharton's Huntsman Hall, room 250. Professor Reynolds had just drawn a supply-demand curve that looked like a child's scribble. This guy 2 seats over, frayed blazer, no-name sneakers, raised his hand. Reynolds pretended not to see him. So he stood up. "The model is wrong," he said. Everyone froze. That's when I learned the first rule of building wealth: never trust the textbook. I didn't know it then, but that kid would go on to manage over $3 billion within a decade. After class, I walked up to him. "You really pissed him off." He grinned. "Good. Macroeconomics treats people like robots. But markets are just fear and greed with a spreadsheet attached." He told me that every stock chart is actually a map of human emotion, and the only number that matters is the one you don't see on the board. That conversation lasted 47 minutes. I took 12 pages of notes that night. Not one formula. Just observations about behavior. That was my real education. Look, I'm telling you this because I wish someone had told me sooner. So if this story resonates, slap that like button. Share it with a friend who's grinding but not sure why. And follow this channel. I've got more stories from the trenches that'll change how you see money, markets, and the people who move them. Next session, Reynolds assigned a 200-page reading on the efficient market hypothesis. Classic ivory tower stuff. My friend, let's call him D, didn't read a single page. Instead, he showed up with one question written on a napkin. If markets are efficient, he asked aloud, why did the CBOE volatility index spike to 40.7 in August 1998 during the Russian debt crisis? Reynolds went silent for a full 9 seconds. Then he said, "That's outside the scope of this class." That's when I knew, the real answers are always outside the scope. One afternoon, D pointed at a footnote in a case study about Enron's early days. "They're hiding $647 million in a special purpose entity," he said. I stared at the page. It was one line, buried in fine print. "So what?" I asked. "So," he said, "if you short Enron right now and hold for 18 months, you'll make a fortune." I didn't have the guts. But I watched him exit that trade at $1.8 million profit. That footnote taught me more about forensic accounting than 4 semesters of financial reporting ever did. Every Tuesday and Thursday, D and I would meet at a 24-hour diner called Lou's on 40th Street. Coffee was $2.15. Pie was stale. But from 3 a.m. to 6 a.m., we'd tear apart companies like we were surgeons. Not for a grade, just because we were obsessed. I remember we spent 4 hours analyzing a single Taiwanese semiconductor firm. We found their inventory turnover ratio had changed by 0.2%. That tiny number predicted a 14% stock drop 3 months later. No professor taught us that. It was just hunger. I lent D my TI 84 Plus in October 2001. He never returned it. But a week later, he handed me a single sheet of paper. On it was a hand-drawn diagram, 7 circles linked by arrows. "This is my framework for sizing positions," he said. "Forget Markowitz. This is real." That piece of paper became the foundation for how I managed my portfolio on Wall Street. It saved me $340,000 in losses during the 2008 crash alone. I still have it framed in my office. During our midterm on derivatives, D picked up his blue book 17 minutes in. He walked to the front, placed it on the professor's desk, and left. 22 people turned to watch. I found him outside smoking a cigarette. "What happened?" I asked. "The first question was a trick," he said. "If they're teaching the wrong answer, I'm not playing." He got a C. But 11 years later, he closed a fund with $2.4 billion AUM. And Reynolds? Still teaching the same textbook. Speaks volumes. D loved this deli called Joe's on 43rd. He'd buy their $6 pastrami sandwich, unwrap it, and say, "This sandwich costs $6. But on a bad day, when you're hungry and it's raining, it's worth $15. Same sandwich. Same pastrami. Different environment." He applied that to stocks religiously. Price is what you pay. Value is what you get under duress. He bought a small oil services company at $4.30 per share because he knew in a supply crisis it was worth $11. It hit $13.70. D showed me a scatter plot he made by hand, 47 data points. It mapped CEO tone during earnings calls against future stock performance. When the CEO uses third-person pronouns more than first-person, the stock drops an average of 7.2% over the next quarter, he said. I laughed. Then I tested it. He was right. I started paying attention to language, not just numbers. On my first 10 trades using this method, I had an 8-2 win rate. Words matter more than spreadsheets. It was March 2002. D had taken a massive position in a telecom company. I'd never seen him nervous. But one afternoon, I found him sitting on the stairs between floors 3 and 4. He was crying. Not sobbing, just silent tears. I was wrong, he whispered. I misread the data. He lost $80,000 that day. But here's the thing, he closed the position, took the loss, and never looked back. If you can't admit you're wrong, you're dead in this business. That lesson cost him money. It saved me millions. D and I drifted after graduation. He moved to Connecticut. I stayed in New York. We haven't spoken in 14 years. But I still use his framework, the 7 circles on that borrowed calculator paper. I still watch for pronoun shifts in earnings calls. I still ask, what is this stock worth on a rainy Tuesday in November? I don't trade on gut. I trade on the lessons a kid in a frayed blazer taught me in an overcrowded classroom. That's the real Wharton education. The one they don't put in the brochure.